What's up, y'all? Today I want to talk about diversification. And there's a lot of different stuff out there about diversification and what you should have your money in or not have your money in, and how diversified you need to be. What does it all look like? And to me, a blue-collar kid from Cleveland, Ohio, a lot of it becomes too complex. A lot of it becomes too mystic. A lot of it becomes a little bit too hard to follow. And so I have a lot of stuff going on, and what I want to do is share a simple way and a simple understanding on how to diversify your investments in your portfolio. So I was at an event this year and saw someone speak who's a money manager for ultra high net worth individuals. This gentleman manages over $40 billion for just 160 different investors. That's an average of about $250 million per person of capital that he manages on an individual basis. So over $40 billion, and he had a very simple diversification method. So he took it into 4 different buckets of where your money should be deployed. And each of these buckets is at 25%. So an equal amount in each one of these buckets is what he advises his clients on. So the first 25% bucket is in public equities. This is the stock market and the things that your traditional financial advisor probably advises you to invest your money in. The issue that I see is most people have 100% of their money into this one bucket, and he's got it at 25%. The second bucket of 25% is in private equities. This is in privately held businesses. And there's a lot of people who don't have privately held investments, especially if you're in a traditional type of corporate role or working a job. If you don't own a business, you probably don't have any sort of money or wealth built into a private equity situation, right? A privately held business. I own obviously real estate, but those I would allocate those towards a real estate investment. My businesses that I own a consulting business, I own a media business, I own a software business, I own a management company. Those are private equities. Those are privately held businesses that I own and have a certain amount of my wealth in. The third bucket of 25% is real estate. So owning either real estate investment trust stocks, or owning actual rental properties yourself, or being an investor in different types of syndication where you have equity upside into different real estate investments along with the tax advantages, the cash flow, preferred returns, all those kinds of things. The final bucket is in dividend producing investments. So whether that is a dividend from a stock, dividend from a piece of real estate, or some sort of fixed annuity, fixed interest rate that you can be earning from a promissory note, a loan that you gave to somebody, then they have a promissory note that they pay to you with a fixed amount of interest and a fixed amount of money that comes in on a monthly basis. That is the final tranche of 25%. And I like what this investment advisor does because you have fixed income, you have tax advantages from owning real estate, you have tax advantages from owning businesses. Businesses have really limitless upside, but could also go to zero. Real estate has a limited amount of upside, but also a limited amount of downside. And then public equities, again, very diversified across many different companies on that side of things. So when you're looking at your portfolio, think about if you have a net worth of $1 million, $250,000 goes into some sort of investment that pays you a fixed return of 8, 10, 12% on an annual basis. $250,000 into different real estate syndications, or you go and leverage that to go buy some rental properties of your own. 25%, $250,000 into different businesses. Maybe you start asking around and seeing which one of your friends own businesses or different types of privately held businesses that you can then make some investments in and ride up some of that upside. And then another $250,000 into the stock market and mutual funds and diversified portfolio into the public equities. Now, when we talk about diversification, that is a good way to diversify your wealth. I've seen a study based on a standard deviation curve that most mutual funds and investment funds that you would put your money with, a traditional financial advisor, has your money in thousands of different public equities. And that diversifies your portfolio about 98%. But you don't know what you're actually investing in. You don't really know what those companies are, who runs them, what the actual assets are that your money's invested in. And in that same standard deviation chart of diversification, it shows that you can get a 96% diversification in just about 30 to 35 different types of investments. And so when you start thinking about that in your own portfolio, if you had 8 to 10 in each one of those different buckets, right? So now I got 250 grand, and maybe I do a $25,000 tranche or a $30,000 or $40,000 tranche in each one of my different loans. That would then allow you to have additional diversification across that class of your investments. And so you could do that across the board. I think that's a great play for somebody who has then accumulated wealth, who has money, they're looking to diversify once they've made their money. I will say this, everybody that I know who has made a lot of money, and actually that money manager told me this about his top 160 clients as well, they all made their wealth in one avenue. They made their money by focusing and being all in one business, in one industry, in one real estate asset class. And they were so obsessive and so committed and became an expert in that one niche. That is how they created all their wealth. And then once they had their wealth created, that's when this 25%, 25%, 25%, 25% diversification method came in. So if you're just getting started, you're trying to create some wealth before you've had a big exit, or you've really developed a lot of money and sitting on a bunch of cash, focus on one thing that just generates a boatload of cash and hopefully a boatload of enterprise value as well, that then you can stockpile some money and create some equity in your business to then be able to either sell it or do something creative with it in the future that's going to give you a big influx of wealth, of liquid cash, that then, to maintain that long-term wealth, you diversify into public equities, private equities, real estate, and fixed dividends. So I hope that gives you an easy roadmap to follow to grow your wealth, and then what to do with your wealth once you accumulate that wealth over time. If you have any other ideas, if you have any other suggestions, I'd love to hear what you're doing with your wealth and how you diversify your portfolio, or if you don't, right? I'm very heavy on real estate right now because I'm all in on that. But I'm also starting to build up the private equity side of my different businesses and what the enterprise values look there, so that way I can cash those in for some larger tranches of liquidity, and then be able to go and invest more into real estate. So we'd love to hear about what you're doing. Put it in the comment section below. And as always, appreciate you being here. Please like, comment, subscribe, and I'll see you in the next video.